Hello, everyone, and welcome to another episode of the Reinsurance Podcast. I'm your co-host, Jerad Lee.
And I'm the alternative co-host, Ben Reyes.
Oh, straight in with the little Easter egg. Today, we're going to talk about alternative risk transfers.
Hence me saying that I'm the alternative co-host, in case that was unclear.
Yeah, but I think we're going to kick this episode off with just straight into an analogy battle to try to understand what are we talking about? What does alternative risk transfer look like? I'm super nervous about this one because we've had guests on the podcast who will also do their analogies, in which case we challenge them. Today we are getting a ChatGPT analogy that we don't know what it is yet. So I'm very nervous on the performance of our analogies versus the aggregate knowledge of humankind.
It's quite impressive, isn't it? I mean, interestingly though, ChatGPT was built by humans.
Yeah.
So we've got some kind of head start there. And in fact, on the creative writing side of things, I was reading...
We've criticized its creative writing skills previously.
Yeah. That might
Are we going to be... It might indeed.
But it was interesting. I was reading... there's a book of short stories by a guy called Stanislav Lem. I believe is Polish. Written like some 70, 80 years ago.
Yeah.
Maybe not that long. Maybe 50 years ago. Don't look this up. Let's pretend I was right with one of those guesses. But the selection of short stories is called the Siberiad, and it's about these two inventors who build all sorts of magical, mysterious machines to satisfy the needs of various other characters. And one of the adventures is one of the inventors builds a poetry machine, and basically it writes poems based on just you pour in all of the great poems that have ever been written at all times, and then you can give it any theme and it will write a beautiful poem, to the point where it became insanely good. And I was reading this literally by chance just as ChatGPT was starting to come to the fore, and it was like, this must be where they got the idea. Thank you, European literature, for introducing OpenAI to Elon Musk. I'm sure he was reading it.
Yeah.
But yeah, it is quite interesting to see how that story ends. You should check it out. I won't spoil it for you.
Yeah.
And
link to the Amazon book in the show notes.
But yeah, hopefully I've stalled enough for us to both come up with an analogy.
That could threaten the ChatGPT. So the analogy I wanted to use for an alternative risk transfer is recognizing that you have this sort of capital class that's trying to deploy itself into new assets. And a bit of that sort of purchasing audience that's trying to make sure they're getting diversified capital. The university I went to is the University of Wisconsin. And just last week, one of their more famous alumni, who was in the NFL for a number of years, just made an investment into a UK football team.
Ooh.
Following Ryan Reynolds and Rob McElhenney's purchase of Wrexham, which is much more well known from their TV show. But alternative risk transfers is like famous Americans buying English football clubs. But
compete with that, ChatGPT.
Come at me, ChatGPT. But the idea here is they've made a huge amount of money. They're invested in a huge array of other products and classes and things, right? Whether it's mobile phone companies or TV studios or production companies and things. But they recognize that there's this other area that actually has a huge following. It's sort of very loyal customer base. It's big opportunity. They might know a little bit about it. They're very passionate about this thing now. They're very keen on it. And they're like, that's where I'm going. Going there. Going to put my money behind that.
It's an exceptionally strong analogy. You played it down well, as always. But no, that's very strong, because it applies as well as much to some of the investors from the Middle East, for example, as well, buying football clubs. But the typical trend being there is an existing market of capital for the industry that is quite constrained in some cases. And then I don't want to use this term in a necessarily negative way, but then some tourist capital that is new to the space from a much larger pool of capital, be it pension funds, sovereign wealth funds, etc., that's looking at this space and being like, well, we could get exposure to that. Why not?
Yeah.
And then they figure out some kind of structure. to do it with.
Yeah.
That's brilliant. I'm going to back your analogy versus ChatGPT here. I don't think I can compete with that. One of the things we'll talk about in this episode is sort of the investor proposition, which I think that analogy sums up really well. Getting access to this different, non-correlated class that's a bit different to your usual type of investment for the investors. But the other side of that, of course, is why would you as a cedent look at an alternative risk transfer solution? So I'll let ChatGPT go next maybe and see which angle it takes it, and then I'll have a quick think about whether there's a cedent sort of buyer angle in there as well.
All right,
we're trying to look at ChatGPT's response, but unfortunately, because it's not a human here with us in the studio,
there we go.
It's a bit slow and quiet.
Oh, it's there.
Here it comes.
Okay, so ChatGPT's analogy for alternative risk transfer. I'll bring my computer to screen so everyone can see it. Alternative risk transfer can be likened to a buffet-style restaurant for risk management. In a buffet, customers can tailor their plates based on their specific tastes and dietary requirements. Similarly, alternative risk transfer allows companies to select and combine different risk transfer mechanisms to address their unique risk profiles and preferences. This flexibility enables them to manage risks more effectively, minimize their financial exposure, and ensure the stability of their operations. I give you a B, ChatGPT.
Yeah,
B minus,
if
maybe.
that. I mean, their analogy effectively says the thing about alternative risk transfer solutions is there's lots of choice. But that doesn't really cut to the heart of alternative risk transfer. You can say the same about reinsurance. Go home, ChatGPT. We don't need you.
But this was when we're not going to spend this whole episode rinsing ChatGPT.
Are we not? That's the only note I brought with me.
But I think sometimes, in many ways, when you task it with things, it comes back with like something, but it can feel quite generic at its current phase. Right? Again, I'm not going to say that this is the entire sort of sophistication that this will ever get to. But
what if ChatGPT is ingesting all of the transcripts of our podcast episodes and not only is learning from our critique, but is also considering us an enemy?
You know, I wonder if ChatGPT is sentient, do we hurt its feelings by criticizing its capabilities to compete in analogy battles on reinsurance?
If it was sentient, would it be most natural for it to be a psychopath?
Almost certainly, yes.
So it doesn't care. It appreciates the feedback in pursuit of its sole goal,
so you've got,
determined by its creator, and yet to be realized by the rest of
its
humanity.
new mission as life is to win analogy battles on the reinsurance podcast. So you've got my analogy of American celebrities purchasing British football clubs. You've got ChatGPT's analogy on buffet style allocation.
Yeah, let me think about this. Okay, so what I want to try and get across with an analogy is this concept that, firstly, reinsurance works fine, and you turn to ILS kind of as like an extra bolt on the door. Let's use that as the base analogy. I may expand from here, but like your house is locked, you don't really need much else, but just in case someone's told you about this other way of securing your home, in the case that something really bad happens and you're kind of like, well, opportunistically I can afford it this year or similar, so I'm gonna buy that extra security camera or that extra lock, and you're not really sure if it's going to work because of this concept called basis risk, which we'll come on to, but at least I'm covering the extreme risk that normally doesn't feel as covered as I would want it to be. So it's almost like a diversifying additional safety for the cedent that may or may not work, but is affordable.
I like it, and I think we could lean into exploring and unpacking that a lot. But you mentioned in that a different term now. You use the letters ILS. So we've talked about alternative risk transfer, but you've mentioned ILS now. Can you help unpack the differences there a little bit.
Here we go. Here comes a awkward Ben disambiguation and taxonomy of a space with which he is only slightly familiar. So alternative risk transfer, I think, is probably the best choice of umbrella term.
Yep.
Typically, that means not a reinsurance contract that depends on the balance sheet of said reinsurer being used to protect you from, the treaty that you've bought, etc. Making sure that gets paid actually out of that reinsurer's own money. Alternative risk transfer is like, okay, how do we access beyond the balance sheet of the reinsurers other pools of capital that are out there? Typically, as we said, the much larger global capital markets and pension funds and all that sort of thing. How that gets organized is normally in the form of securitizing a risk. Hence, we end up with this term insurance-linked securities.
Yeah.
What form they can take varies enormously. But typically, these are involving a sponsor, first of all. So we call the person who is the cedent the sponsor. They sponsor a special type of entity, which is normally a special purpose vehicle, protected cell company type. Doesn't employ anyone, doesn't do anything, but it's a little company that's set up in a favorable tax environment with the express purpose of holding on to the collateral, effectively, the funds that are going to be held to pay the claim, earning as much of a return as is safe to do so by being invested into, some money market investments or otherwise, and then also having added to it a premium paid by the sponsor, so the cedent, effectively giving their premium to this vehicle that sits and holds it and invests that alongside all of the potential claim to be paid out, sits in this special vehicle, such that then, should an event occur based on a range of potential triggers, that fund will either go to the cedent if the event does occur, or if it does not occur, it will go back to the investor, who, if nothing happens, this is quite a hit or bust product typically, then the investor gets their original collateral back, plus any interest gained, plus the premium paid by the cedent.
Yeah.
So that's the very kind of high level concept
of ILS.
Of ILS, securitizing these things. The reason that it tends to be applied to mostly short tail risks is because these investors are not necessarily in it for the long game. They want to know that at some point they're going to be able to take their funds out of said special purpose vehicle. Hence, it's been quite difficult to apply ILS consistently to long tail lines and casualty, because they're worried about, as happens, funnily enough, with short tail lines as well, getting trapped collateral. So we saw a lot of challenges with events that had to be adjusted over a longer time period. So if you didn't know what are the claims due on recent hurricanes, for example, then you were a bit stuck with the HIM ones, for example, the Harvey, Maria, etc. And the ILS investors were like, hang on, shouldn't we be getting our money back by now? And it's like, patience, please. We're still calculating how much of your pot has been eroded or not. But the way this works typically is, and I'll let's take a cat bond as a basic example here,
which is another type of alternative risk transfer.
Yeah, it's probably the most common form of like ILS based on the kind of model I described, and they can be big or small and take various structures. You can even have cat bond lights, but typically it's like a 144A cat bond or this kind of thing. But what you need to really focus on here, I guess, is just the idea that instead of the premium, effectively we call it the coupon and this sort of thing that goes to the investor in it. So they effectively have, rather than a promise to pay like you would if it was a reinsurance deal, the investor has basically put their money into this pot that can then be passed around. So there is a secondary market here that doesn't exist in the reinsurance normal kind of balance sheet based world. That means that catastrophe bonds can be traded afterwards. So they actually do gain and lose value depending on how close they are to their maturity, etc. Because at some point it looks very sure that the money is going to be recovered from that PCC or otherwise. In other cases, it looks like you're going to be potentially losing all of the money, in which case the bond isn't worth anything. So there's this interesting secondary market aspect to it.
Yeah, there's an interesting point you brought up on from the investor appetite of, the preference of short tail risk, at least in the earliest stages of that. And there's some challenge happening there now. We'll see how that pans out. But I think that's a really interesting one. So a decade ago, when I had just come to London, I was working on the broking teams. ILS was beginning just to start to make waves. And there was a real concern there, to that your exact point, that we're very familiar with the big reinsurers who write on balance sheet, because this is their thing. That, like, they're not going to then next year, RenRe's not going to close up shop and do something entirely different or put all their money elsewhere. Like, this is the business they've selected. But with the ILS players and investors, there wasn't really that same confidence. And for a lot of clients around the world, who we've talked about this countless times on the podcast, but they look at their relationships with reinsurers and their capital providers over a very long time horizon. And this idea that they might be here for this one renewal and then be gone again, is it really worth like signing down the existing, leaders and the, markets they've been working with for decades, giving them less of that book for like this one-off who's going to float in and leave next year if they have a loss? And so it took a while for that part of the industry to sort of establish itself and go, yep, we come in, we do pay the claims, and we come back the year later and we, have continued to return. However, you're seeing a bit of that money go elsewhere now, but it's been, 11, 12 years. But yeah, there's a little bit of a reservation that the clients have around that. And I think, going back to my analogy, you see similar things with these clubs. For the fans, this club is at their world. And how exciting it might be to have these famous new owners come in. There's a reticence that if the club doesn't get promoted or doesn't, win a league or similar, that they're just going to leave. And then all of that excitement that they had actually hurts more, that, the tide has gone out now and they'd rather just have, carried on. So I think when you have that sort of, the importance of this for clients causes a bit of that reticence, at least in the early days before ILS really built up a better reputation there. But yeah, you're right. They certainly had to weather how the industry actually works, with even short tail risk taking a longer time to be sort of fully understood.
No, absolutely. And I think those exact conditions drive the way in which ILS is often bought as well. It's typically purchased by, I would say, the regular purchasers are those who are having to deal with a risk that just isn't going to get placed in the traditional markets. So a lot of government or public bodies, for example, you've got like the California Earthquake Authority, is every year in there for their cat bond to protect against California earthquake, because one, there isn't enough capacity in the reinsurance market to cover that kind of event willingly or at a reasonable price. And so it's actually easier for them to market that as a cat bond instead. And it's very similar for lots of other authorities the world around. The World Bank, for example, others will buy cat bonds for that same rationale. And then, interestingly, insurers and reinsurers apply the same kind of logic, but based a little bit more on the reinsurance market cycle. So this year in particular, actually, you've seen quite a lot of reinsurers and insurers, actually primary insurers as well, coming to market to buy cat bonds specifically for the US and often Florida exposures, this kind of thing, where they know capacity is constrained, they're going to get really beaten up on price if they go through the traditional markets. And so you've got lots of big reinsurers using ILS effectively as a form of retro, opportunistically. So they'll say, okay, we could try and place this as retro, but there just isn't the reliable retro capacity there for those markets at a price we're willing to pay. So this year, or for the next few years, we're going to buy a cat bond, or we're going to set up some kind of vehicle that will protect us there. I want to come on to, because it's really interesting as well as part of this, one of the reasons why it's often cheaper to go down this route, which is there's something called basis risk, which is involving the trigger basically for these special vehicles that contain all the money you need in the event of a claim. Now, it is possible, so don't think this isn't the case, for your trigger to be an indemnity trigger. So you had this many claims, and therefore the vehicle will pay out the funds to you. That is possible, but it's actually not the main case. Actually, lots of other triggers are more popular, because if you're just going to use an indemnity trigger, you might as well buy traditional reinsurance at the end of the day, and there's no extra incentive for a very distant third-party investor to get involved. That's much more like a traditional reinsurance relationship. Interestingly, a lot of ILS capacity feels more comfortable getting involved with things like a parametric coverage, where you're asking a unsophisticated, in reinsurance terms, investor, your celebrity football club owner, to take a bet on whether the wind will blow or not, or whether a named hurricane will land in a region or not, which is something they can get statistics on through structurers and advisors. They can really understand what is the calculated probability of this, and is that a useful addition to my portfolio or not. And they don't have to do the sort of reinsurer relationship part around how good is the underwriting team at the primary insurer, how much have they got a handle on these terms and coverages within their own book. And this creates what we call the basis risk, in the sense that what happens at a parametric level. Another way of doing it is an industry-wide aggregate measurement. So how many losses did the industry report? And special agencies like PCS, for example, try and secretively track a sort of anonymous aggregated loss from an event to be able to give these triggers currency. But there's quite a risk that you, as an individual insurer or reinsurer, experience a different level of claims experience to the market as a whole, or to the extent to which hurricanes fell in your neighborhood. And that's what we call basis risk. It can work both ways. You can actually profit from it if you had actually a relatively good year, but luckily you were the holder of a bond that paid out if a hurricane brushed past you. But it can also go the other way.
But it's different in many ways to how insurance traditionally works, because you don't have the ability to make a profit more broadly on an insurance product that has this indemnity clause associated with it. And this is kind of why players in this sector on these types of products have a bit more of a reputation for feeling like gambling, because you can kind of come up on top if the wind doesn't blow and you predicted it wouldn't, or similar. And you don't need that relationship, that longer term portfolio strategy. You can come in with capital and go, based on the models that we have, we think the likelihood that one of these events won't happen or will happen, and we'll put money towards those. And then if the storms are sufficiently light that year, they don't pay out and everyone's golden. But obviously that they lose the vast majority of that then, because a lot of times it's triggered in its entirety, isn't it? It's not where, say you have a 10 million limit, but your loss is only 4 million, so you just get 4 of your 10. This is more of and for most of the products, again, nothing is absolutes in our industry, but for most of the products, it's more of if this thing happens, this whole pot of money comes to you, and if the thing doesn't happen, you get none of it. Is kind of where you see more often than not.
Well, I think actually the most important point you've made there is it is entirely bespoke every time, right? So the issuer and the sponsor, etc., they will really design something unique every time, true to the characteristics of reinsurance. So some of these look very much like a specialist cat bond deal. Others look suspiciously like traditional reinsurance excess of loss deals. So, for example, I think Zencuren buy a cat bond quite regularly, and they issue it in effectively 2 layers. So one kicking in at 1.5 trillion or something. I'm going to get the numbers wrong, and then another one that kicks in at 2 trillion. Almost certainly not those numbers, but some, and it's probably yen as well.
This might be
yen, to make it sound a lot more reasonable. But it's structured in such a way that even within the ILS investor space, loss picking is possible. So you can say, do you want to be on the lower layers and pick up some of the relatively attritional cat bond risk, or do you want to be on the higher layer of this cat bond? So you can do different issuances, and they almost get translated into more financial markets type language, like, oh, do you want the A's or the B's in terms of tranche, but really they're kind of saying, do you want the top layers or the lower layers?
Yeah.
And I think this hybridity is very common in the industry because it is being reinvented and invented all the time. You look at, sidecars as another thing that plays in this space, and that's effectively a clever quota share with some investors who want to participate that don't have underwriters or claims teams. So they set up a way of following the fortunes of an underwriter. You look at another way of thinking about this, collateralized reinsurance, right? You don't have the ratings and the balance sheet of a major reinsurer, so you're willing to participate as a traditional reinsurer, but in order to play with the big boys who've got A+ ratings, you put all of your capital on the line and you hold all the capital that's needed to pay the claim, rather than being able to say, no, I've got a balance sheet that means I don't have to.
Yeah.
So it really is a bit of a playground, and has been for 30 years now.
Yeah.
Where people have been constantly inventing things, and we haven't even come on to ILWs, weather derivatives, all that sort of thing as well.
Well, and I think when you look at the industry, this is an amazing example of the creativity that brokers have, and then how they partner with capital markets to solve client problems. But again, if we sort of talk back to what would have been sort of the organic emergence of these as products, it comes from broker executives sitting with a client talking about the biggest concerns that they have protecting their book. And during those conversations and things, it will have come out that, but what if insert shocking event here that blows out their tower, or they have a certain proportion of a market. I think the reason ILWs are so attractive to very large carriers and cedents is that they have a sufficiently large portion of that part of the market. And if that market has been hit by an industry loss of X, it's very likely that they have taken a very large chunk of that. And so it's an easy way for them to go, even if like our little book, for whatever reason, how the contracts get written means I'm not recovering everything I'm hoping I should recover here for whatever, nuance that happened, the aggregate loss in the industry will still have hit us very, very hard. And this is a means by which they do that. And I'm sure there's tons of other reasons why these products get designed and built the way that they do, and it'd be fascinating to talk about that in a different episode. But you can kind of see that organic evolution of this emerging of, a client need saying, here's a pain point we don't feel is being protected by our traditional tower. Yeah. And then the brokers going to the capital markets, people that they know and everything else going, what if we did something like this? And then once that first version goes out, then it's like that creativity, as you just said, begins to be unlocked. And I was like, well, we could create this different every time. What if we did it this way? What if instead of it being a loss warranty on a thing, it was a bond against this catastrophe happening? Or what if, and again, I don't know the order of which these things emerged, but you can see that sort of natural creativity that gets sparked in a space like this.
So I'm not sure if what I'm about to say is technically an analogy. So I'm almost doing a flip analogy. We're going to try and do an insurance analogy where I describe why it's not like insurance. But
okay.
We'll go for it. But to me, the thing that came to mind was actually add-ons. If you look at your portfolio of protections in insurance, as a consumer, for example, you buy car insurance and you've covered basically, as far as you know, all of the things you need to cover. It's a bit like then going, okay, but there is a chance that my cover that I've bought doesn't fully meet my needs, or something a bit out there happens or a bit unexpected. And so you get, and this is why it's slightly different, because typically you go to market and say, will anyone support me for this peril? But when you get offered, wrong fuel cover, for example, it's like, your insurance policy won't protect you if you put the wrong fuel in your car, kind of thing. Would you like to add wrong fuel cover? Or that your no claims bonus will be lost. Would you like to protect your no claims bonus as well?
Yeah.
It's kind of like...
I just hope someone's listening to this in their car with just black smoke coming. Like, this is me right now, shouting at there.
But yeah, it feels a bit like that, right?
Yeah.
You look at your protections as a cedent and you go, yeah, I'm generally happy with the protections I've got in place, but I do have this outstanding concern about this thing that's not fully covered or would be really expensive to cover. So would anybody out there be happy to cover me for this exclusion in my policy, or this extra bit of reassurance at the right price?
Yeah, it's similar in many ways to like umbrella policies as well, where you're going, well, I have liability limits on my home and on my car and things of this, which I can't see a reason why I would ever go over those limits. But what if there's this, horrendous accident that happens and now you're being sued for, hundreds of thousands or millions of dollars or pounds? You have this like umbrella that sits across everything that says, just in case, this sits here, right? And it's that same way of looking at it going, almost certainly these things won't happen, but it's not zero. So for, I can afford to buy a little bit extra cover here, and that will give me this additional comfort should anything happen.
It's like, let's say you've got, here we go. This is not quite the right economics, but you have a train ticket booked for a certain time to get home after a work party. Everyone can relate to that on the Reinsurance podcast. And you're aware that there's a slight chance that you miss your train. And so you also provisionally book a hotel as well. You're probably not going to use it. You might not even be in the right neighborhood for that hotel by the time this night ends. But, if things do get a bit late and you don't actually manage to make your train, you've got this other kind of potentially useful plan B that might actually not work at all. But at least you feel a bit more secure because, the hotel was available. So you can get that just in case I don't make it home.
Yeah.
As I said, the economics probably not quite right there. Unless it was a very expensive train and a very cheap hotel.
Yeah, and if it's something that you net benefit from, you have a very high moral hazard.
The party got cancelled, and I didn't need it, but I've got this hotel for that.
Yeah, exactly. So the party is back on at this hotel room.
Oh, you buy some snacks and put them in your bag in case dinner is terrible. And if your dinner is great, then you don't need the snacks. You're like, or you have the snacks as well because your dinner was great and you were still hungry. It's unrelated to your actual risk experience. You have the snacks in your bag, regardless, kinda.
Yeah, and just like a cat bond, they will expire.
Yeah,
you don't have these snacks forever,
and you can sell them on the secondary market for snacks. If you meet a homeless person and you wouldn't sell them to the homeless person, that would be
just donate them.
Ethically questionable.
Yeah,
you would give them to them.
Yeah,
I hope.
We started and ended with analogies on this episode. I think this is a strong one. The analogy bookend episode of alternative risk transfers.
Yeah.
We should have someone who's an expert come in and talk about this.
Definitely. Well, I mean, thinking of ideas, interestingly, on experts to invite. If you haven't checked it out already, I highly recommend Steve Evans' pages on Artemis.com. There's loads of great definitions and guides there, and they have an amazing tracker, so you can see all the latest cat bonds as they come to market. That's a great way to learn, is just to go through a lot of those. And there's a lot of experts in the market. We saw actually in the news, a bit of tasty news, Tom from PCS has just moved to Inver as well, but he having run that sort of industry loss measurement company for a very long time, is a great source of knowledge if you can get in touch with him as well. So maybe we can persuade one of those guys to come on the podcast sometime too.
Well, this might be a multi-parter. We will see. But until next time, thanks everyone.
See you soon.